All right, so stocks rebounded today, and the biggest shocker of the world that nobody expected would happen. We rallied more than 2.5% on the S&P 500. So I'm going to break down how bullish it was, right? We talked about it on Friday. We expect more of it to come out this week. So the question is, is this trend changing? Did we get a runaway gap? Are we going to get a Tom Lee rally now? I saw today on CNBC their big market bear came out and said that this is the bottom, that they're going to get a sharp rally in Q4, and this is a good time to buy. So is that the case? So I'm going to break down what the charts look like to see if that is indeed the case. What's driving today's move to see if that supports a Tom Lee type rally into the end of the year. And then we'll take advantage of what actually did do well today with our trade idea of the day. So let's go ahead and get started. Today is Monday, October the 3rd, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here in the bottom left corner of your screen, as well as that subscribe button down there. Hit the thumbs up icon to like our video. Comment on anything that stood out to you. Join our website at marketscholars.com with that link right up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. If you're watching here on our blog, check out some of these classes over here on the right, our calendar, our Market Outlook live video. Come down to the bottom. We only got 86 likes on Friday's video, so again, we're trying to shoot for over 100. Again, just click that heart icon. It opens up this tab. Hit that like. Same thing, hit the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do those two things, you can do right now while you're watching. It helps us. It helps us get our content out to all of our followers on those social media platforms. All right, so as we get started here, I did want to address a couple of comments that came through. Linda's comment is a great summary of my expectations and targets. Again, if we are actually going into a bear market, ultimately, if we kind of stop here at 3,500 and then bounce like for good, then obviously this isn't a bear market; it's just a correction. So this would be a really good summary of my expectations. And again, 3,200 would be, again, kind of the end of this return move to and through the 200-week moving average. In my opinion, that's not the end of the bear market. That would just be the end of this move. And then we would get as was mentioned here, the return move back up to the 200-week moving average, and then eventually moving down lower. Somebody asked on Twitter about ultimately where I think it will go down to, and again, I'm expecting it probably down to the COVID lows. Again, full-on bear market. That's where we'd expect it to go. I was also asked, why wouldn't I sell a call vertical rather than buying a put vertical? Because again, you saw, Maria, that I got double the return for half the risk that I do on a short call vertical. I'm getting so for $1,000, I generally get about $350. So I'm getting over $600 for around $500 of return for $500. So it's a lower probability setup, but I get again nearly double the reward for nearly half the risk, buying the call vertical than selling buying the put, than selling the call vertical. I also wanted to do a little hat tip out to Mary and to Russell and to the BIYTC. Thank you for the thanks. We even got one from, I believe this might be from Estonia. So thank you very much for that. Again, those come from the super thanks, and you can be able to click on either one of these and let us know if you find these videos valuable for you or not. All right, the S&P 500, you notice, rallied today, 2.5%. Shocker, right? We didn't know it was going to rally this week because, again, we were so oversold last week. Who knew that it was going to bounce up today? Well, it bounced up today. We gapped up. It wasn't a significant gap, so I wouldn't necessarily say this is a runaway gap. I mean, it was a little bit more than one standard deviation, but generally speaking, the last runaway gap we had was 719, so right in this area. It was also just a little bit above, about 8.84%. and then we ran away from the open, and we ended up finishing up, let's see, 2.7%. Well, today we got to 2.64. So, you know, it has a lot of makings of a runaway gap. This is what it looks like here on this chart, and that's why it's like, how much of a runaway is that really? Again, when you look at 719, see, that's a runaway gap to the downside. See, pretty obvious there, right? Here's the runaway if I were to go back out to that 719 time frame. So it'd be down over here. There's the, let's see, this would be right there. There's the runaway gap on 719. Let's see, it'd be this one actually, 719. So you can see the gap up, and we just run away, and we even had one there too on 727. Gap up, and we just run. We don't fill them in immediately. So not really. You can't really say necessarily that we had that kind of a gap here. So I wouldn't necessarily say that this is a run, like we're going to start a new intermediate rally here. I still think that this is just the beginning of a near-term rally. Just like I said last week, the near-term line will finally get above 60, most likely tomorrow, if not Wednesday. It will finally get above 60, and it'll probably hang around there for probably throughout the rest of the week, if not into early part of next week. I remember early part of next week, we start to kick in gear with earnings, and we also have like the CPI report's going to be coming up here in a couple weeks. So there's a lot on the plate in the next little bit. So, but I do expect we'll get up towards 3,800. We got the 3678 today. We're still more than almost 6% below 30-day moving average. Not surprising, the momentum line and near-term line rallied, but I mean not by very much. But barring a big drop tomorrow, they should continue that, even if we just get a little bit of an upward move. You notice on the whole, we did get a higher close, so we got a higher close, and now it's a matter of, okay, are we going to close above this body tomorrow? And as of right now, the likelihood is high, because you know your open tomorrow is going to be 36.46 roughly. We're already trading at 36.78 right now, so the likelihood is pretty high we'll get a Hakinyashi close above today's body on the Hakinyashi candle. And that would reverse, right? That's our reversal. So something like this, right? That's a reversal. Rather than getting the higher close and then reversing back down to the downside, like we did here and like we did over here as well. So, you know, again, you can see the short-term move. Market sentiment, intermediate line still below 10. So it's like, again, you know, how many days now? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days that it's been below 10. Again, good day tomorrow, we're probably going to get out of that. But that's a lot of days being below 10, where generally you're only below 10 for maybe a day or two before we rally back up. So market sentiment line's falling. It's almost below the midpoint of the chart. Remember, getting below 40 is significant, but you're dropping. So and your intermediate line's easily below 50. So we're still in bearish mode despite. I mean, it's not like we haven't had a move to the upside during this, you know, since the last CPI report. We've had a couple of good, strong up days, including today. So and all the indexes look almost exactly the same. The Nasdaq kind of lagging behind, so it doesn't look nearly as bullish because it wasn't as bullish. Still over 2%. The intermediate line is, you know, at 6.5% or percentile. So it's pretty far down there. The Russell is actually a lot closer to getting back above 10. So it's looking a little bit better from that perspective. So a really good move right now in the S&P. Looking at the weekly chart, you can see as of right now, this would be a higher close. As of right now, obviously we have 4 more days left, so we'll see how it finishes. But as of right now, it'd be a higher close. So again, we've seen that before. And then we'd have to close above this week's body to reverse it. So something like this, right? We get the higher close, and then you notice we didn't close above this body until, you know, 4 weeks later. But we finally did, and that was our reversal. So, but then getting back below this one, so you kind of had it here. So you got it up. We did not get above that body, and getting back below this first day, like this, the lowest close of that. Getting back below that would be your reversal back down. So we never got back down below that here because we reversed up. We did get back down below it here, and we kept going down. So as of right now, we're kind of flirting with a higher low point. They're right at the same level. So we'll see if we stay bullish throughout the rest of the week, which I assume we will. We'll probably end up getting a higher close there by the end of the week. If we take a look at the 3 green arrows chart, we don't have 3 green arrows. So again, we're not bullish. I know, I mean, every day we go higher on TV, it seems like the bull market is back, baby, right? But the reality is we're not, and look how, it's going to be a long time before we get 3 green arrows. And you can see that's what you need to get going to the upside. So we're not anywhere near that. If you look at the 2-line version of that chart, we're not even above the 8-day exponential moving average. As strong, I mean, we were up over 2.5, 2 2/3%, and we still couldn't get above the 8-day moving average. Again, that's how bearish we were, and that's how much it takes to get going. And again, when there's big gaps between these, it's hard to switch it. It's hard to get going to the upside until those gaps shrink. And then you can cross multiple lines at the same time, as you'll see later today with our trade idea. But the MACD is close to crossing above its moving average. Very, very low. Remember, the MACD is very low. So that, in fact, the moving average is the lowest point it's been pretty much all year at minus 2.25. You can see the moving average got down to over here minus 2.2, right? So, and then over here it got to minus 2.10. So, you know, today we're at, you know, 2.25. This is the lowest that the moving average of the blue line has gotten all year long. That's how bearish we've been. So we've been pretty bearish. It's not surprising. Stochastics has crossed above its average. Now keep in mind that stochastic, when you look at it on this basis, it's still in the lowest, you know, quintile of the 4-week range. So there's still got a ways to go. Again, we're not that bullish, right? We're just not that bullish. I told you before that a rune indicator, you know, it's gonna, both lines are gonna be dropping all week. We're not gonna get in, I assume we're not gonna get a new 4-week low this week, and we're definitely not gonna get a new 4-week high point this week, which means both these lines are gonna drop towards 0 on the green line and below 70. Then we can start to consider, and again, it takes 6 days to get that red line from 100 to below 70. So where are we gonna be inside that 6-day window? Are we gonna be, you know, up here closer to the high or not? If we're still stuck in this area, even though we haven't got a new low, then we're most likely not going to get, you know, a breakout. And again, a new break above to 100 on the red line, which is a new 4-week low, then that just starts the window all over again. You're still bearish. And that's, I actually assume that that's going to be the more likely the scenario. I mean, we are looking at some of these other oscillators here. We're still at the low end of neutral, you know, still pretty negative there, below 0. We're still below 40 in the RSI despite the rally. The DMI negative indicator is still well above 25. The positive is not even close to being above 25, so hardly any kind of reversal pattern there. Looking at the Bollinger Bands, we are still in the lower half of the Bollinger Bandwidth. Again, you have to get into the upper quartile to really make a change. We're not even in the upper half. So, and that was a 2.5%, 2 2/3% move. And you can see how that's just how bearish we've been, that we can't even, like, we still have a very mature bearish trend going, and we're still well below the green and the blue lines. We're still well below the cloud. The red line is still well below price, which means the 26-day rate of change that you see here, which is that's what that red line is looking at. It's 26 days ago. We're still, I mean, it's still the lowest levels. Again, we're nowhere near being back above 0 to get any kind of bull, I mean, which is what you need to get any kind of bullish, right? You need to get above 0, and then you can stay above 0 for a while. You can get above 0 and then stay above 0 for a while. So we are nowhere near getting above 0. We can get there quickly if this thing can take off, but as you can see from this chart, we're probably not going to get the red line above price anytime soon. So don't get worked up about these up days. They're not, I mean, it was a nice day. It was a higher high, it was a higher low. We closed above Friday's high. That's a nice day. But it puts into context that we are still easily inside last week's range. And we still haven't finished filling in that gap. We still haven't finished filling in that gap. I assume we will throughout this week. There's a gap in volume here that once we break today's high, we can really get going up to 380. And that's where I kind of think we're headed. 390 at best case scenario. 380 is our most likely scenario. So that's kind of what, at 3,800 on SPX. That's where I think we're headed in the very, very short term. If you look at the volatility today, Volatility is still, I mean, it's below 100%, so like we can't get above 100%. We did open above 105, drop below 100 again. This is a bearish pattern for volatility. I expect volatility will be bearish the rest of this week. The question is, how far will it drop? But I expect we'll probably come down to the 30-day moving average. It's 30-day average by the end of this week. That's what I'm thinking. If you look at the VVIX has come back down pretty sharply, right? You had this big drop last week, and it's been coming down ever since. So the VVIX, remember, this is correlated with the VIX. It's dropping too. You had this, so you're pretty bearish in volatility. It's hard to be too bearish on the equity market when volatility is dropping as much as it is. So, there's more than likely, we're bullish today. It's great. I don't think you'll get like, multiple 2% up days in a row. It's not very common to do that. But it doesn't mean we can't get a few 1%ers here or just a small little gain. We might not be done with 2% moves during this little rally. We're more than likely going to continue to push, get some green bars as we move towards resistance. Towards resistance around 3,800, right around these lines, these Fibonacci lines. Remember, this is all noise until you break above 3,760, which is the 23% retracement. The long-term 23% line is where the 38 is. So again, from a long-term basis, if we're talking about this whole year-to-date decline, it's just noise until you break above 38.75. So that's why I say 3,900 is kind of the best-case scenario for us to just be kind of in a retracement, in a noisy bounce up, but not a trend-changing bounce up. Just a move up. We were so oversold. Move this up, now you're not going to be so oversold, and kind of like you did over here in June to expiration, that's probably what we're going to get going in towards October. Probably 2 and a little bit through October expiration is the kind of move we'll ultimately get moving down towards 300. See, this was a move from 4,200. We got about 41.75. We ended up dropping down to a low of 36. So we ended up dropping over 500 points, and so if we get to 3,800, and we'll probably drop towards 3,200. A similar type of move, probably not in just 3 days, so it'll probably take a couple of weeks to do that, but that's the kind of move I expect we'll probably end up getting before we wash out again at 3,200 and then start a new intermediate rally up back towards 3,800, kind of on a longer term, a little bit slower basis, kind of as gradual as what we had right there after some kind of consolidation. After we maybe touch 3,200 and then consolidate around 3,500 and then work our way back up. So, all right, now let's take a look at what's driving the price action today. And of course, this is the biggest driver today, the weakness in the dollar. The dollar dropped, the pound, there was some intervention in Japan and in Great Britain, supposedly. So obviously that's going to be weak for the dollar, which is probably not a bad thing. The dollar's been going parabolic. So you had some weakness in the dollar. That pushed everything up. It even pushed yields down. Bonds rallied, but they didn't rally as much as equities or commodities. You can see gold really rallied. After a really good week last week, right? Gold really rallied with the weakness in the dollar. So you had some really good kind of reversal type moves. But again, like equities, not trend changing. Like there's long-term bonds. That doesn't look like it's like blowing you away bullish to the upside. Gold, had a little bit better move. It actually broke 2 lines, right? It broke above the 17 and the 30. That's about as good as you can get. But gold is below its value area for the full year. It's still below the 50-day. There's still a gap between the 50 and the 30 that we have to fill. And of course, the gap between the 50 and the 200 just keeps getting bigger. Again, a lot of this is dollar strength. Even though gold is outpacing equities, it's been going down against the dollar. And that's what you see there. Yields dropped today, but again, that doesn't look like it's overwhelmingly bearish. So your MACD finally is, below its moving average, and we are almost below the 17 days. So you're kind of in convergence mode, but it looks like we're probably going to start to consolidate some of that, insane rally that we've had in yields. And again, that's going to be relatively bullish for equities when yields soften and the dollar soften. And ironically, that's going to be bullish for commodities. And again, the MACD is above its moving average. We're not above the 17-day yet. There's a big amount of supply overhead. So it's not going to be able to take off to the upside. But incidentally, it was up 2.25% today too. But that's not what we want, right? We don't want commodity prices to be high because that will keep inflation high. We want commodities prices to come down. That's the whole bullish narrative, right? For moving to the end of the year, that commodity prices start to come down. That they're correcting, they come down. Even though them coming down here and correcting is actually really bearish because it reflects, you know, demand destruction. But regardless, that's kind of what the bullish narrative is. So for it to keep going up won't necessarily be the best sign, right? That will allow the Fed to actually continue to raise interest rates with higher prices that might continue to push, especially the median portion of the CPI, the kind of stickier portion, to keep those levels high. Obviously, the outsides, energy and food, depending upon which side that they're on, have been really big movers. So they kind of take those out, and you got that kind of core middle, which is more sticky. And right now, remember, is still at its highest point that's been in decades, despite the pullback in the headline CPI. So that's kind of the major moves in the different asset classes. Bitcoin, incidentally, Bitcoin is holding a really important support level. So it did kind of bounce up a little bit. You can see it there. But this level here around 18,000 is unbelievably important. 78% retracement of this big long-term move. Obviously this year's low. Breaking below that would really throw Bitcoin for a big loop. Like, it would be a big breakdown. You can see on the 5-year chart, you know, you would pretty much be dropping down to 10,000. And then it's a matter of whether it's going to hold support there at its point of control. I mean, that would pretty much wipe out almost all the post-COVID gains, right? I mean, this is about where it was at pre-COVID, right around 10,000. And then it took off with, you know, the small cap, the stay-at-home trade. It kind of took off with that stay-at-home trade. It peaked at about the same time as the stay-at-home trade did. And of course, it's gone nowhere since and has been, you know, bearish, more bearish than even equities have been for a lot longer. Because remember, equity, the S&P peaked here at the beginning of the year. This was already in a decline before that. I mean, we had our pullback pretty much at the same time that the S&P was peaking. And then we had, while the S&P was in its pullback mode, Bitcoin was actually doing its failed pullback bounce. Then Bitcoin had its correction, and right now we're kind of trying to figure out a correction bounce. And so far, it hasn't been bouncing very much. But, you know, it very well could as we approach, you know, as the market itself is trying to figure out what to do in the short term. So look for Bitcoin maybe to get up towards its 17-week moving average. But again, breaking 18,000 will, for this end of the risk spectrum, the risk appetite spectrum, would be really bearish, which would mean that longer duration asset class, that higher beta asset class, that risk on, the most risk on of asset classes, it would kind of show that right now there's not a lot of demand for that, which means there's probably more demand for safety and for capital preservation, which again is a reflection of the overall investor sentiment and where we're at right now in the cycle, right? In these cycles, these stock market sentiment cycles. All right, let's take a look at the sectors and how they performed today. Obviously, they rallied. The big mover today was energy. If you see energy there, energy really took off, rallied up over 5.5% today, more than double the S&P. Consumer discretionary, thanks to Tesla, did not move up very much. In fact, it was flat on the day, ups and downs, but ultimately ended flat. You can see other big winners today. Materials, not surprising. Industrials and utilities, a little bit more surprising. And technology kind of fitting in there too. Communication services kind of lagging a little bit behind, a little bit, you know, outperforming the market briefly. And then, of course, your safety trade. Healthcare, staples, real estate also lagging, but still more than 1.5% gains, which kind of shows that there's still pretty decent demand for safety, right? Even as the more risk appetite asset classes really kind of took off there. Of course, when you look at it on the 12 grid, then you can see as much as we've rallied, it's still pretty dark pink shading in a red line everywhere except for energy. Energy, the intermediate line, did get above 20. It's the only one that's even above 12. See, materials is 12. Healthcare is at 13. Energy is at 23. So this is the most bullish. Of course, it's the closest to the moving average, and it's already got the light green shading. It's got to get above that moving average by enough to pull it back up to get that green. So, you know, we're nowhere near yet like 3 green arrows and a good buying opportunity on energy. It's actually a little bit, it seems to be a good, you know, obviously it's a good mover right now for this little short-term rally that we're in. I wouldn't necessarily say this is going to be what's going to lead us higher into the end of the year. If we ultimately do get that Tom Lee rally, you would expect it to be these 3 up here at the top. All right, if you take a look at, sticking in the energy sector, if you take a look at Valero, interestingly enough, we got a bear tag today, which means we got light green shading in the yellow line, which means the light green shading means that we're rising, the intermediate line's rising, it's above 20. And rising, so it's actually above, you know, 34, so it's almost out of bearish territory and almost above its market sentiment line. The yellow line means that we're above a falling moving average. So a bear tag can either be a reversal pattern, right? So we bounce off of it and continue to head down, or it's the beginning of a bullish intermediate run. And for energy, you would think that considering the weakness in the dollar here, coming off a parabolic peak, that you might be getting the beginnings of a little bit of an intermediate run. Again, the last one didn't last very long, so I wouldn't expect this one to get, you know, again, anywhere near 127.5, because getting above that ends the retracement and we're back on that trending move. I don't think necessarily we're going to be getting to new highs anytime soon on Valero, so I think we'll probably get back up towards 127.5, like we did over here, and peak again in that level. So looking at some of the other indicators on Valero, you can see we got that transition kind of the higher close last week, but we are closing so far. It's only one day, but so far we're closing above that body, last week's body, and that's good. That's a good reversal sign. The PPO is trying to turn back up again. You got the green arrow, which means we close back above the 10-week moving average. That's a good sign, especially considering the 10-week is still above the 40, which is one of the rare stocks that are not in a death cross environment right now with the pink shading. When you look at the 3 green arrows for Valero, we did get 3 green arrows today, so we didn't quite get a big spike in volume, but we did get 3 green arrows there. So, and the nice thing about this jump above the 30-day moving average is it also is a jump above the 50, and we got above the 17 all today in the same day. We're above the 1-year point of control. We're still in the value area, but at least we're above the 1-year point of control and above just about every moving average now as a result. So pretty good sign there when you're above all moving averages like that. And you're 8 and 17, your 8's about to cross above the 17 with this MACD looking to get above 0 there. Some good momentum on that MACD histogram. When you look at the DMI, the positive indicator jumped above 25, the negative fell below. So that's a good sign. Not below 20 yet, but at least it got back below 25. So it's not a breakout sign, but at least it's a good sign that we're not bearish anymore. We're not above 60, but at least we're above 50. We're not above, the positive 150 or 200, but at least we're above 100. So, you're getting small, weak signs of bullishness. When you look at the Ichimoku cloud, we're still below the cloud, but we are at least above the green and the blue lines now. The strength of that bearish move is waning. It's not down to 0, but probably another day away from dropping below 0. We're not into the upper quartile of the Bollinger Bandwidth, but we are at least in the upper half now. So if we can follow through on this and really push through, being above the point of the point of control and all those moving averages, and it's a good sign that we might start to push up higher a little bit. But again, without the bullish breakout patterns, what I decided to, and with earnings coming up too, no less, after October expiration, but before November. So I went out to November expiration and did a bull put spread. So I sold the 105, bought the 100. I only did 2 contracts, and here's why. So normally I would do 3 because I would do $1,000 of risk for a relatively high probability trade like this. But considering earnings is coming up, I can get the same amount of reward that I typically shoot for $1,000 of risk, but I can do it with less than $700 of risk. That's the benefit of the higher premium we're getting with the earnings coming up. It allows us to reduce our risk, which we want to do when you have a pretty volatile period like this. Again, I think it's after October expiration, but it's obviously before November when this trade goes through. So I pushed that through, and like I said, a normal reward for about 2/3 of my normal risk I'll take for a relatively high probability trade like this. All right, well, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads that are open, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to us on MarketScholars.com as well for free, and like us on Twitter and Facebook too. Have a great rest of your Monday night, everybody, and we'll see you all next time.